Ladies and gentlemen, good day and welcome to the Escorts Limited Q4FY15 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Raghavendra Jaipuria from Perfect Relations. Thank you, and over to you, sir.
Thank you, Darren. Good evening, everyone, and thank you for joining us on Escorts Limited Q4FY15 results conference call. For today's call, the management would be represented by Mr. S. Sridhar, CEO, Escorts Agri Machinery, Mr. Sunil Saxena, CEO, Escorts Construction Equipment, Mr. Dipankar Ghosh, CEO, Escorts Auto and Railway Products, Mr. Bharat Madan, Group Financial Controller, Ms. Jyoti Khatuka, Head Treasury, and the Investor Relations team at Escorts Limited. We will start the call with the brief opening remarks from the management, followed by an interactive Q&A session. Before we start, I would like to add that some of the statements that we make in today's discussion will be forward-looking in nature. At this moment, I would request Mr. Madan to make his opening remarks. Thank you, and over to you, sir.
Thank you, Raghavendra. Ladies and gentlemen, a very good evening to you all. Thank you all for joining us on the earning call for fourth quarter and financial year ended 31st March 2015. A snapshot of company's annual performance is as follows. Turnover at rupees 3,986 crores against rupees 4,263 crores last year, down by 6.5%. This is primarily due to drop in tractor volumes. Tractor volumes went down by 13.3% to 59,779 tractors against 68,963 tractors last year. Construction volume, however, went up by 7.7% to 3,007 machines against 2,793 machines last year. EBITDA at rupees 161.4 crore against 274 crores last year, down by 41.1%. EBITDA margin now stands at 4% versus 6.4% last year. The major reason for the fall in profitability as compared to last year is the lower tractor volumes and the increase in other costs, mainly coming from the consulting and export expenses. Finance costs also went down by 15% to rupees 57 crores. The total debt outstanding as of March 30, 2015 is rupees 481 crores. PBT before exceptional items stands at rupees 98.9 crores against rupees 206.1 crore last year, down by 52%. The company reported a PAT of rupees 74.7 crores versus rupees 179.3 crores last year. EPS is reported at rupees 6.26 against rupees 15.36 last year. The board of directors have recommended a dividend of 12%, that is 1 rupees 20 paisa per equity share of rupees 10 each for the year ended 31st March 2015. Now moving on to company's quarterly performance. The turnover at rupees 818 crores as against rupees 983 crores last year, down by 16.8% on year-on-year basis. The tractor volumes went down by 29.1% to 11,036 tractors against 15,556 tractors last year. Construction volume, however, went up by 9.3% to 740 machines against 677 machines last year in quarter ended March 14. EBITDA at rupees 22 crores is down by 51.9% against rupees 45.8 crores last year. The major reason for the fall in profitability as compared to last year is basically lower tractor volumes. The raw material cost went down by 110 basis points to 70.9% against 72% in the corresponding quarter. The company reported a PAT of rupees 12.8 crores versus rupees 31.8 crores last year. Now moving on to segmental business performance. Starting with the agri machinery business, domestic tractor industry volumes went down by 13.1% to 5.5 lakh tractors as compared to 6.33 lakh tractors last year. The sentiment of the farmers and the industry has been dampened firstly due to delayed and below normal monsoon season and then untimely rains just before the harvesting season. The continuing lower crop prices, lower outlay in Manrega along with the tight funding via the credit agencies due to poor redeployment of the old loans, bad debts in states like MP, Maharashtra, etc. were important challenges. In Q4, industry degrew by 30% at 97,000 units against last year's 138,000 units. The agriculture sector struggled with the untimely rainfall and hailstorm in February-March across multiple states. Our domestic volumes also went down in line with the industry. Our domestic market share stands at 10.5% in year ended 2015. Our export volumes, however, have more than doubled from 901 tractors last year to 2,214 tractors this year. In line with our strategy to become market leader in higher HP segments, our tractor volumes in 50 plus HP grew by 53.6% as compared to last year. Our market share in this segment also grew from 6.6% to 9.7% on full year basis. This segment also grew by 5% in the declining industry. Continuing with our strategy to offer innovative products, last year we had launched new products like ALT anti-lift tractor series under the PowerTrack brand and XP series and FT6050 4-wheel drive under the FarmTrack brand. The market response for the newly introduced models have been very positive. The new models are creating product pull-based market demand amongst the prospective buyers. Going forward in the current fiscal, we shall continue to bring new products. EBIT margins in EM went down by 290 basis points to 7.1% against 10% last year, primarily due to low volumes. We are on track in our project in reducing material costs and better margins are expected once the industry turns the corner. Now coming to the construction equipment business, while the overall construction equipment industry seems to be bottoming out, our served industry segment continued to decline. The served industry volume for the year went down by approximately 10%. Our total volume, however, went up by 7.6% to 3,007 units against 2,793 units. In Q4 also, our total volume manufactured as well as traded products went up by 9.3% to 740 machines against 677 machines in the last year's same quarter. In construction equipment, backhoe loaders and cranes have led the growth. Backhoe loaders grew by 20% year-on-year in an industry decline of 12%, while the cranes have grown by 7.7% faster than the industry growth of 2% on a full year basis. Our backhoe loader Digmax 2 has been well established in the market and we are only player to grow in this industry on both volume and market share basis. On the back of this increased volume, our revenue also increased by 11% to rupees 515.8 crores for the full year. In order to stem the losses, we effected price increase across all product categories, increased our channel outreach and increased our tie-up with retail financials. Though EBIT loss for the full year is more or less in the same range, though it has considerably gone down in Q4 from rupees 9.9 crores to rupees 3.35 crores. Going forward in next year, we expect that our served construction equipment industry will continue to face challenges. Any recovery is only expected to happen from second half onwards. Coming to the railway division, the railway revenues are marginally up at rupees 183.7 crores as against rupees 182.5 crores last year. The EBIT margins are also up by 105 basis points at 9.5% against 8.5% last year. Revenue for Q4 is also up by 21% correspondingly to rupees 54.5 crores. EBIT margins were correspondingly up by 920 basis points to 19.1%. Order book for this division stood at approximately rupees 45 crores, which will get executed in the next 3 to 4 months. Given the government's focus on revitalizing the Indian Railways, we are very excited on the future outlook of this business. To capture the opportunity, our endeavor is to expand our product range either through in-house development or through technology partnerships. We got the developmental order for axle-mounted disc brakes recently and we are working on the same. Lastly, the auto division achieved a revenue of rupees 103.6 crores against rupees 128.8 crores last year on a full year basis. EBIT losses have gone down on a full year basis and also on the quarterly basis. A positive swing of 1366 basis points on the YOY basis and 900 basis points on quarter-on-quarter basis is seen in EBIT margins in Q4. This is achieved mainly due to cost saving from VRS, margin expansion due to sales portfolio rationalization and improvement in operations in the division generally. Going forward, our focus will be to increase the sales in high margin segments and achieve break-even. Now I request the moderator to open the floor for Q&A session.
Thank you very much. We will now begin the question and answer session. Any participant who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question is from the line of Ashutosh Tiwari from Equirus. Please go ahead.
Yeah, hello sir. So my question is on the tractor industry per se. What kind of decline you expect in the first quarter and how do you see the volumes in this year per se, considering the farmer incomes are under pressure? And are you seeing the defaults happening on the farmers' loan side also, which is also impacting the demand for tractors?
The industry, the overall, our own forecast for the year is a flat industry. Last year it was 5,50,000 was the tractor demand, domestic demand, and we expect that to be similar this year also. For the with reference to the quarter, I think the current degrowth is happening at the level of 15 to 17% for the month of April, and this will continue for the entire quarter is our estimate. Possibly the same situation also will continue for quarter 2 as well. The recovery will start happening only from the quarter 3 and quarter 4, and overall it will be a flat year. But with reference to customers defaulting, loan payment and all other issues, there are some difficulties with reference to higher purchases, the loans extended by NBFCs. I think it's still in the manageable limit. I don't think it has gone out of, it's nothing to be very alarming about it as on date.
Okay, and right now what would be the level of inventory, the stock levels with the dealers for industry per se and for you?
See, we generally do not go all out in terms of stock push. So either within the quarter or the next quarter, we generally correct our stocks. We do not take this chance of pushing too much of a stock into the system. But having said that, we do see a possibility of, to the extent of another 1,000 number scope for reduction is there, that we will do over a period of time. Once we do that, we will be well within that, which is something like 2% kind of an excess stock. So for us, it's really moderate. And similar will be the situation for industry. I think last year, between first 6 months and second 6 months, industry also should have considerably reduced their stock. So I think now onwards, we should start looking forward to deliveries or the retails reflecting the wholesales as well.
So in terms of number of days, how many days of inventory would be there for industry per se on a rough estimate?
Industry, I will not know, but we can say something like 45 days to 50 days is a good estimate.
Okay. So, and second thing, sir, is this downturn basically in the tractor demand is across India, or there are some pockets which are still doing relatively better, and which are the most impacted and which are still doing better?
But if you have to speak about the last year, it was uniform throughout. Everywhere the problems were similar. But the rains, whatever we have suffered of March rains, where it's more about north, more about our own packets. Otherwise, the decline is uniform throughout.
Okay, sir. And sir, you said in the construction equipment, you have seen a strong volume growth in backhoe loaders and all. But if I look at the profitability of the segment, still it remains under pressure. So, I mean, how would that change basically going ahead? Because I think last quarter you mentioned that in the fourth quarter probably you can break even in this segment.
This is Saxena here. If you really look at the construction industry per se, the backhoe comes under the category which is the earth moving segment, and the entire construction industry has been in a state of decline for the last 4 years. The best quarter we had possibly in terms of changing the sign or which was showing some kind of an improvement was quarter 3. But unfortunately for the industry, the quarter 4 was again a kind of a quarter where further things declined. As we are looking at quarter 1 and quarter 2, we are expecting the decline to continue. While there have been good announcements on the ground, the project spends have not yet started. And with the kind of equipments we have, if we have to look at the 23 type of equipments, the only equipments which are seeing some element of green shoots or some element of better performance month on month have been the off-highway trucks, the excavators, the screening plants, the motor graders, the crushers, and to some extent compactors. Now, unfortunately for us, the backhoe continues as an industry to decline very, very rapidly, of the order of about 17% as you see in April also, and we expect this quarter 1 and quarter 2 to remain in that 17 to 20% range in terms of decline on backhoe. So the industry, which was one time about 3 years back operating at about 3,400 to 3,500 machines per month, has come down almost to less than 1,500 machines a month. That's the state of situation right now.
And the pickup on this will happen only if the road products are basically fast enough, and that's the only thing.
No, not just that. What really is happening is there's a huge amount of machine park, which is the utilization levels are low. So even if it improves in the first half, you will not see the pickup in the market. You will start seeing the pickup when the real growth starts in terms of spending almost across the segments. So you will first see equipments like excavators and compactors and motor graders doing well, crushing plants doing well, followed by backhoe maybe 6 months from now. So you don't see the backhoe market dramatically moving ahead, at least in the first half.
Okay. And sir, my last question is on the tractor side, how is the discounting in the segment? I mean, discounts are on the higher side. It has increased in this quarter also, or how it is right now?
Nothing left for this quarter. Everything started maybe much earlier actually. Nothing really changed because this is effectively 6th month of a major fall. It is 30% negative growth. This is the 6th month. So whatever has happened has already happened. So nothing more is expected. This competition intensity may continue for some more time, another 3 or 4 months, and then it will settle down.
Okay, sir. Thank you so much.
Welcome.
Thank you. Participants are requested to restrict their questions to one per participant. Our next question is from the line of Nishit Chalani. Please, from Nomura. Please go ahead.
Hi, sir. Thank you for taking my question. My question pertains to the tractor segment. Like previously asked, how is the discounting level? We have seen the margins come off from 7.8% to 4.6%. Is this purely due to operating leverage? What kind of commodity benefits have we realized, and how should we see benefits going ahead in the next few quarters?
I think as we talked about in the opening comment, the material cost in the last quarter, if you compare, it's gone down by about 110 basis points. So definitely the project on the material cost reduction is very much on track. So overall, if you look at the margins, the drop basically is on account of volume. So if the volumes were same at the last year level, the margin you have seen the improvement in this quarter also.
So sir, all the benefits related to commodity prices have already come in this quarter?
No. So it just started. So like I said, the project which just started was somewhere in June. It's a 2 years mandate. So I think the major benefit we'll see coming in this year, and the full benefit will be in next year.
I'm talking more from that is about your cost reduction exercise. I'm talking more from the global commodity prices coming down. So benefit of that have we seen in this quarter, and how much can we expect in the next quarter?
I think this quarter, yes, the commodity prices have softened, so we are getting some benefit, but not a significant one. I think it's close to 0.5% really on the bottom line. Mm-hmm. But we don't know how the second quarter will look like with the inflation probably going up and the commodity price with the crude also moving up. It may start moving up. But for this quarter, definitely first quarter, we are getting some benefit on the deflation side.
Okay. And sir, just one more question. You mentioned you expect the industry to be weak in the first half, and then we should see some pickup. So what gives you confidence that the industry will pick up? Is it due to you expect normal monsoon, or you see some construction related buying in tractor happening? Basically, what are the drivers which will lead to the recovery in second half?
Okay, I think on a very basic level, the second half means from the period like November to March, this year itself has gone through a 30% fall in industry. The lower base itself will be the reason why it should be much better. That itself should take care of to the extent of something like 20% growth, just because we had the last year was an acute, the lower base. Okay. Having said that, this monsoon related problem started somewhere like February of last year. So almost February 19th or 20th is the first year-end monsoon situation started happening. So it has to end somewhere. And overall, we feel that this year it should not be an abnormal year. This year should be more or less a consolidation year. And then on the back of some 13% minus of last year, and this year being a flat, the recovery, even though the second 6 months is more because of the lower base effect, you will see market aggressively growing from January, February, March onwards next year. So this is how the pattern will be.
Sir, just to clarify, your guidance of flat volumes builds in a normal monsoon, or if even if the monsoon is relatively weak, we can still see flat volumes. Basically, what is the assumption here that we are taking?
No, our assumptions are normal monsoon.
Okay.
But otherwise also the worst case will be something like a -3 to 4%. It cannot be worse than that.
Okay, sir. Thank you.
Thank you. Next question is from the line of Amin Pirani from Deutsche Bank. Please go ahead.
Good evening, sir. Thanks a lot for the opportunity. Sir, I just want to go back to the question on tractor industry growth. If we look at last year, in addition to the monsoon, obviously a lot of other factors like NREGA funding coming down and other government not increasing the minimum support prices. Given that we may have a normal monsoon this year, the other issues which have caused the tractor market to fall, they are unlikely to change because this government seems to have taken a different view compared to the last government. So even going forward in fiscal 17, given that these factors will remain adverse, can we see a strong growth or we have entered a phase of much lower growth? Just want to get your views on this.
Okay, it's purely our view. It's very easy to put the blame on the government, but we have a very different view.
Sure.
The most important here is, for example, how much money the customers are realizing and what kind of a sentiment he is experiencing are far more crucial than the government policy. As far as tractors are concerned, tractors are almost like our cars, our bikes, retail products. So these factors are more important than government policy.
Okay.
And if you look at the long-term trend of this thing, something like 8% CAGR is already there.
Okay.
It has been there.
Right.
So if you look at it last 4 years, excepting 13-14 where we had a 20% growth rate, these costs need to be compensated. It's all bought by the individual level.
Right.
They all need those kind of tractors.
Right.
I'm not against the government. I've compared. Government is going to give concessions. They are most welcome to do so. But more important thing is sentiment. The sentiments are on fire on two grounds as far as tractors are concerned. One is timely monsoon and then spatial effect. How it is spread uniformly throughout.
Right.
So the water, more water is always better than less water.
Right.
So those kind of a monsoon plays very important role.
Right.
Second is food inflation. This I think I have mentioned even a year back.
Right.
Food inflation has a very crucial effect not only in terms of realizing the money, but put the customer sentiment on fire.
Correct.
So this food inflation being rigidly controlled, obviously it's a little bit of a setback for a tractor manufacturer.
Right.
Because the customer sentiments are guarded. But I assume that these things, food also now, you cannot control it beyond a point. So you will see all those things are, right now some signs are seen. I'm not saying it fully.
Right.
The food inflation will start recovering. It will go into, it may not be 12%, 13% like happened in 13-14.
Right.
Even 8 to 9% or 10% is a very, very welcome situation for farmers. These kind of things are on the cards is my feeling. It's all suppressed for some time, but eventually with a good monsoon and this kind of an area, with a low base effect of the second 6 months, means we should get prepared for an extremely good 16-17. I think this is what we are visualizing.
Okay.
So and the CAGR should be of 8 or 9%. We should take it as the basic thing for this industry.
Okay. So basically you're saying that even if minimum support prices are not raised, food inflation itself would increase and, ultimately result in higher cash flows for the farmers.
That's right.
Okay. And sir, coming back to your own growth in the 50 HP plus segment, which you mentioned in the presentation, your market share has definitely increased in that segment. But in general, how has the market itself behaved? As in, despite a minus 13% for the full year for the industry, have different HP segments performed differently, or all are more or less in the same range?
I think there are only two growth vectors, one in the top, one in the bottom.
Okay.
The top is above 50% and then the bottom is less than 20%.
Okay.
So the less than 20%, we do have a participation, but not a very significant player there.
Right.
Okay. Whereas the above 50% is of a very high strategic importance for us, for one of our brand.
Right.
Farm Track revival is depending on how well we enhance the image.
Right.
So 50 plus, we look at it not from volume point of view, but in terms of reviving one of our crucial brand.
Right.
So 3 years back, we made this statement saying that in 3 to 5 year time, we want to become a lead player for the premium end segment.
Right.
From almost like 1.5% market share, which was a 10-11 and 11-12 situation.
Right.
Now we are almost at a 10% market share on this segment.
Right.
Going forward in a year or two, we will reach something like 16 to 18% market share. The good thing about this is this is also has a lot of profits. This also sets a trend for others. It's very, very important for a company like Escorts to win that kind of a category, because this will set the tonality for the next category, which is 41 to 50 horsepower, where a lot of products are there in the pipeline,
right,
which will be riding on the success of this category. So there are a lot of internal actions are on cards in this financial year.
Okay, so you're saying that you could gain another 5 to 6% market share in this 12-month period itself?
Of course, in a year. I would say rather than another. See, right now we are at a 10%.
Right.
Okay, I think 12 to 13% is already visible in one financial year.
Okay.
Possibly the end goal is something like 18%, which may take one more year.
Okay.
We are on that path. See, this is not a precision of market share. It's in terms of action what we are putting in. A lot of products are coming actually.
Of course.
Yes.
So as of now, your share in the above 50 and even in the 40 to 50 is almost the same, because your overall share is around 11%. So, and you're saying that in the premium segment, your market share growth could be higher than in the mid segment. Is broadly that's what you're saying?
Yeah, of course, but you should also see the background. 3 years back, we were at 1.5%.
Of course.
From 1.5%, we are talking about 18% in 3 to 5 years.
Right.
This is in a way is magical actually.
No, absolutely. Absolutely. I mean, so no doubt about it. But sir, going forward, given that the industry is likely to go through, say, an 18 to 20 month period of downturn, if I take overall last year as well, plus you as well as I'm sure even other players will try to gain market share. Could we see price competition in the industry higher than what we've seen in the past, or you feel that the industry would remain well consolidated in that sense?
I think, see, the tractor players, as long as wherever you have a very high installed capacity, this kind of a price play will come into play. I think this is no brainer. It's happening in the tractor industry also. Okay. That the most important reference is we said we will not participate.
Right.
This is why like our own internal EBITDA targets are we moved something like the division targets are very sharply from 4 to 10, and we also said we will go up to 15. Right. Ideally we should have reached 15 in a year or two. It may take another one more year. Okay. Otherwise we are on that journey. So most important thing is not what the industry will do. Most important thing is what we will not do. We will not go into that price-based competition. So our obsession with that 15% EBITDA is it stays. All our strategies are meant for that.
Okay. Fair enough. So thanks a lot for taking my questions.
Thank you.
Thank you. Participants are requested to restrict their questions to only one per participant. Next question is from the line of Ashish Nigam from Axis Capital. Please go ahead.
Hi, my question was on capacity utilization. What are the capacity utilization levels for tractor and construction equipment?
The tractor is at close to 60-62% utilization level last year.
Okay.
And the construction side, we are at about 23% capacity utilization.
23.
On full year basis.
Okay. Secondly, your railway equipment margin, I probably missed that in the opening comment. It's seen a sharp increase in railway margins. So is there, what driven the improvement, and is it sustainable?
Yeah, it is sustainable. Primarily because we are now introducing new products which have higher margins. And what we are also doing is that we have started a huge exercise of material cost rationalization and also some of the productivity improvements. So we feel that we should be able to maintain a good, healthy margin, the percentage in the coming quarters also.
Okay, so you all have that cost-saving program, I think with McKinsey and BCG. Has that played out in railway? That's the savings we're seeing here? Or is it that's yet to play out?
It needs to play out. I mean, this is without the BCG for this particular railways. BCG has not still come in railways.
BCG are more meant for auto products.
Okay, and just overall, just with these cost-saving programs, when will these savings kick in? Do you expect in FY16 or be the year after?
Yeah, so I think the major portion will start coming in from this year towards the second half of this year. And full year impact we'll see in FY17 coming in for the entire project.
Okay, so on related lines, you'll expect the break-even for auto anchors and construction equipment by this year?
Yeah. So H2, like I said, is more possibility because H1 does not look like any recovery possibilities are there in the construction volume. So H2 is a bright possibility of having it. And on auto product, again, it's a Q4 which we're looking at as a break-even quarter for us with all the initiatives which you put in.
Q4 FY16?
Yeah.
Okay. Just lastly, your tractor exports also have done pretty well. Which markets have done, have contributed, and what's the outlook there?
It is more towards African region. A lot of institutional sales. The base volume also has gone up. Institutions also has gone up. But having said that, our base was also low, something like a 900 numbers to 2,200 numbers. The real capabilities will be seen from now onwards when we target something like a 3,500 numbers. But as of now, it's a big stretch. Maybe it takes a couple of years before we go into like a doubling and tripling the volume where that's the intent where we actually put it into action.
Okay. Also, your tractor margin, going up from 4% odd currently to, hoping to go up to 15% in 2 years or whatever. How much of that will be driven by operating leverage and how much by mix and how much by, let's say, your just the cost cutting playing out?
See, the cost cutting as of now, what you see, like still what you were saying year before last year, something like a 9 to 10% was achieved through a normal value engineering process itself. That means more through a pricing power and what we have done this. Okay, this is the way we have moved up to 9 to 10%, and through that way we would have moved even up to 11%. Now this, when you are talking about this kind of a material project, what we are going through, Shikhar, what we quoted as internally, it's supposed to add at least 2% over and above this. That means the roadmap is almost clear to the extent of 12.5 to 13%. Beyond that, we have to build on. So that will come through certain better volume, scale, and certain mix issue. And together it will take us to 15%.
Okay. Thanks a lot. All the best.
Thank you.
Thank you. Next question is on the line of Raghunandan from Quant Capital. Please go ahead.
Thank you, sir, for the opportunity. Sir, we were planning to launch new products in the tractor division along with design changes which can drive raw material cost savings. By when do you see those launches happening? And secondly, when I look at the JD Power rankings for the tractor division, for any of the HP segments, we don't come among the top 3. So just wanted to understand, what is that we are lacking on the quality and where is the scope for improvement and what are the plans on this side? Thank you, sir.
See, JD Power is, if I'm to tell you a little more controversial, I don't think the TMA has participated. I'm not talking about Escorts. The whole industry has not participated. So it's a very private creation. So very difficult to comment on something which there was no wholehearted participation by the major players excepting 1 or 2. So let me not go into TMA route. But for the general question what you asked about the quality, we did have some nagging issues over the past. That was something like 4 or 5 years back. All those issues were pinned down. Now some of the quality benchmarks what we are doing is, see today the products whatever is getting developed is, it's not only for India, it's also meant for certain European markets like Germany. So the standards what is being put in now is a transition from the best of India into a best of European kind of an industry. So maybe these things are in a transition, so it may not be fully realized. So maybe 2 years from now, we will be very proud to quote our quality references as one of the finest references for India. So I don't think the quality is an issue today. See, the issue today is something to do with the portfolio, something to do with mix, power, and something to do with the regional mix, portfolio mix, and those kind of area we are addressing it. For example, wherever power track and farm track is playing together for like a northern zone, we have a very attractive market share of something like a 17 or 18%. Whereas the south and west, something like a 4.5% market share we have for the last 2 years. This is a large gap. But within the north itself, where we have farm track dominating zones and then power track dominating zones, there the market share in the respective category will be much higher. So some of this area is also portfolio issues. So this is where we started launching products. This is happening in the last, I think, November, December onwards. Will be complete, almost complete by the next December. In this, something like a 12 to 13 months, the portfolio will be complete. This will also greatly enable us in terms of further recovery of market share. The market share which was hovering around something like a 10.5 to 12%, we have an internal plan move it up to something like a 12 to 12.5%. So it's a question of 12 months to 24 months before we start seeing such a huge growth momentum in market share.
And the new products which are coming in, would they be incorporating the design changes, sir, which should help the RM cost?
Of course, these things are definitely it will incorporate. This is not only, some of these products what we are doing also will help us in terms of realizing better pricing. So it has a twin objective of not only incorporating what you called value engineering designs, also it will realize us in terms of realizing better price from the customer.
Thank you, sir. This was very helpful. I'll come back in queue for more questions.
Thank you. Our next question is from the line of Apurva Kumar from Jefferies. Please go ahead.
Hi, sir. Just one question on the penetration level of tractors in different geographies. Sir, are you seeing that there are pockets of states where the tractor penetration has kind of plateaued, and that thereby the growth in those geographies will be flat compared to certain other states?
See, I think this is our view. Tractor penetration, for example, is very high in the states like Punjab and Haryana. It may be very low in south and west. But the approaches these markets bring in are very, very different. It is like, black and white TV getting replaced by color TV with LED, LCDs. And see, the technology upgradation is also making the existing tractors as obsolete. So these changes are taking place. So this is too early to worry about what you call the stagnating industry, which we do not even foresee for at least the next 10 to 12 years. Okay, so the industry which are all latecomers, if you have the south and west, where the penetration levels are not that deep, the way the Haryana and Punjab has gone up, perhaps they start with a better tractor size. They straight away start with 45 to 50 horsepower and 50 horsepower and above, those kind of a tractor. So they approach the tractor a little differently. But otherwise, stagnation is not one of our concerns.
Right. That's it from my side. Thanks, sir.
Thank you. Next question is from the line of Mitul Shah from Karvi. Please go ahead.
Yeah, good evening, sir. Thanks for my question. I have 3 questions. One is on the other income that has gone up significantly in this quarter. Interest also gone up and capital employed, sir. If you can explain this.
Mitul, on the other income side, we got a refund from the income tax department this time. So it's a big refund which came. It's about 6 to 8 crores. So the additional interest income which has come in this quarter is on account of that. And it's a non-recurring item. But this year the other income has gone up basically because of that. And there's some other interest income which has come from the channel finance side which has gone up in this quarter. So overall about 10 to 12 crores impact is actually on account of these non-recurring items. Coming to the finance cost, the average borrowing, the working capital utilization level has gone up in this quarter. So we ended this quarter with about 481 crores of loans. Against I think it was closer to about 450 odd crores in the previous quarter. So typically this quarter in terms of volume has gone down significantly. So as a result, the borrowing cost has gone up. But if you look at overall year, the overall finance cost has gone down by about 10 crores. We are 67 crores. We are at 57 crores this year. And your third question was on the return on capital employed. So are you referring to the increase or are you referring to the change which you have done?
Capital employed has increased significantly across all the segments.
Yeah, so actually there is a note which is there in the result if you see. So the method of calculating return on capital employed, we have done a change this time. Earlier the short-term borrowings and the term debt which was repayable within 1 year used to be part of current liabilities, and we used to reduce it from the return on for the capital employed calculation. So from this time, we actually excluded that borrowing portion to be part of the current liability. So as a result, the current liabilities have moved up. So have gone down. So as a result, the capital employed has gone up. So there is a disclosure which has come in the results if you look at the bottom line there. And note number, reference is there. Note 6 to 7.
So on the other expense also, the promotional expense, I think we launched a commercial 2 days back. So going forward, how do you see this advertisement expenses, etc., going up in view of that competition is also increasing and industry is slowing down, inventory level are quite high for next 2 quarters? What would be the situation?
So there'll be some pressure definitely on that, but as of now, like you said, we are looking at a flat industry, so we're not expecting any major recovery to happen, so we're more or less flattish here. So no significant increase is expected on the cost side. So we'll see how the market then responds going forward. We'll take a call at that appropriate time.
So do you expect promotional expense to go up significantly, at least for next 2 quarters?
No.
Not significant.
Yeah. It's under discretion. I think we will not put a lot of money towards promotion.
And sir, last question on this. Generally, we have observed whenever there is a consecutive decline in the monsoon deficit for the 2 years back to back, then there is a significant erosion or negative impact on the agri side happens in the second year. But within this, South and West generally underperform significantly, while North outperforms because of the natural water available over there. And we do have strong presence in the northern region. So any possibility of strong outperformance of Escort?
Yeah, but the way we should see it also, as I said, is the North also had that untimely rain this time. March and April was not a very favorable thing for our own zone. But we should also realize that the South and West, even with the first monsoon, they will spring back. The facilities like hire purchase and those kind of the market ability or the enabling structure in the South and West market are far superior compared to what you call UPs and Bihar in terms of NBFC availability, penetration, and those kind of areas are very, very good. So when they start growing, that growth will also go into 40 to 50%. See, end of the day, these things, that is why sometimes the market share will always present a very skewed picture depending on where exactly the growth happens and what exactly happens. Most important for us is the way we are all preparing ourselves. But as I said, we should start looking at some consistent improvement in market share is what we should look for, because all that portfolio gaps, what we wanted to fill, should be over around last quarter of this financial year. With that, I think the way has to be only the way up for market share.
Yeah, thank you, sir.
Thank you. Next question is from the line of Viraj Kacharya from Security Investment Management. Please go ahead.
Yeah, thank you for the opportunity. And most of my questions have been answered. Just 2 more. If you can just provide some color on how's the growth been in the sub-20, sub-25 HP segment?
I'm sorry, can you please repeat?
The growth in the sub-25 HP, how has it been? You mentioned that there are 2 segments which have grown, the sub-20
Yeah, I think there is some, it's a double-digit growth. I don't remember the number exactly because we don't make a lot of money there, so we don't count on that. See, what happens is this kind of a segment also depends on government enabling. Depending on which government is offering what subsidy. For example, there is a big program put in by Gujarat government in the month of, I think, March. So it's also on and off kind of a market, but overall, we realize that it's very important that we are present in those kind of a market because this can be spread to many states. We don't want to be caught unaware. So those kind of areas are getting prepared, but most significant for us is not the development in that market. Most significant for us is the market above 50 horsepower is growing. And that is where we are betting on to start with image, subsequent on volume.
Okay, so, for us, how's the scale-up been in the sub-20 HP segment?
I'm sorry?
How's the scale-up been for us? Because we launched a brand name, Steel.
See, I think we have an outsourced partner who's an Adigo. That company, now we have found a joint venture as itself. So already I think 500 odd tractors were put in market. It's all well accepted. It's all undergoing approval process. As I said, this is also a subsidy-driven segment. It's meant for small farmers. There's a lot of subsidy elements also gets involved. We are almost there. So as and when we hit that, the numbers will happen. Again, the numbers can be something like 150 times. 150 to 200 kind of a number is what we should look for. But it will give us a very decent returns. It may not be our notional 15% EBITDA what we are chasing in our tractor division. At least half of that is an easy possibility in that kind of a product. Those kind of things are on the cards.
Okay, so we are not looking at seeing significant market share in that segment, but just an enabling to all strategy on focusing on the higher HP segment. Is that the right understanding?
Correct. We do not add it up. We keep it aloof, little away.
Okay. And anything on the other agri equipment?
I'm sorry?
other agri equipment that you're planning to introduce? So anything?
No, not now. Maybe some of these things are in the advanced stages of conclusion, but timing is not right. We cannot enter now. Possibly the whole thing we will be evaluating for the second 6 months, so that the scale up happens the next year, but not as of now. See, today what happens is whatever resource we have to put it on those kind of geographies and product lines where the returns can be little quick. So we cannot take what we call it as difficult task. This is not the year for the difficult task. This is for the year for what is possible is what we have to do it quickly, actually.
Okay. So is it on the heavy agri equipment side, on the light agri equipment, anything on that side?
No, nothing. As I said, is not this year.
Okay. Okay. That's it from my side. Thank you.
Yeah. Thank you.
Thank you. Our next question is from the line of Basudeb Banerjee from Antique Finance. Please go ahead.
A couple of questions. As you said some of the earlier participants that your utilization is close to 60-odd%. Is it for the full year, sir, or the last quarter?
Full year basis.
So as for the last quarter numbers on an annualized basis, it is close to 45-odd%.
That's right.
So, as you said that the volumes are going to remain flat in coming quarters, so if one prorate these kind of numbers, so at this utilization level, will it be right to assume this 2.5-3% kind of margin to sustain?
No, but if you look at there is a seasonality built into the entire year. So normally you see the high volumes coming in the first quarter and the third quarter of the year, and normally Q2 and Q4 are the lower quarter volume months.
Yeah.
Don't look at it only one quarter in a independent manner. So March quarter will not give you the right perspective for analyzed volume. So your Q1 and Q3 will definitely be the higher volumes. So overall, in our opinion, if you remain at a level of about 60,000 volume, which is what we did last year, so we'll be in the range of 7 to 8% EBIT margins.
EBIT margin?
EBIT margins.
From a AMG segment itself?
From the AMG segment, that's right.
Sure. And second question is, sir, as you said that you are aiming to reach 15% market share down the line. Presently, it is close to what, 10-odd%?
See, I think what we have showed is when we just look back something like 13, 14, when we were doing a volume of something like 68,000 without the support of the material project, what we are trying to do, that itself was placing us anywhere around the 9.5% to 10%.
Yeah.
See, that as a reference if you have taken. Then we have talked about the material project will give you another 1.5 to 2%. Will place you at a 12. And some of this product and portfolio program is going to give us another 1.5. That means this is where I have already mentioned something like a 12 to 12.5% is highly visible to us.
So broadly, as per your internal study, so correct, from whom you are expecting to grab this 300 bips market share broadly?
See, this we cannot disclose about exact competition strategy is very difficult to disclose. But if I am to give you one broad idea, one of the major vacuum area was lack of participation in the haulage segment. Some of the brands were doing very well, and there we have launched an interesting product, and that will become significant over a period of 1 year.
So basically non-agri segment, haulage carrying goods through the tractor segment.
Yes.
And any regional skewness of haulage application of tractors, or it is pan-India broadly?
No, it's a pan-India phenomenon.
And primarily it is into the higher horsepower segment?
Yeah, of course it's there everywhere. So, see, this is like a lot of detail, and just let me keep it close to my chest. Give me 2 more quarters.
Sure, sir. Thanks. That's all from my side.
Thank you. Our next question is from the line of Kishan Gupta from CD Research. Please go ahead.
Yeah, hi, good evening, sir.
Good evening.
Yeah, just want to understand, assuming that the tractor markets remain turbulent this year as well, so what defenses you have in place to protect your market share and volumes?
See, if you look at it in the last, when you are talking about, let us say the acute portion of a fall, which is something like a 30% fall in the industry, it's happening in the last 5 months. And incidentally, our market share is highest in the last 5 months. It's like 11% times. So, we are already at that kind of a rate. From an overall rate of 10.5, we are already at 11% in the last 5 months or 6 months, 10.9 and 11.1 precisely. So, this is number one. Number two is, See, in the last 3 years, many of our strategies are backed by interesting products, innovative, refreshing products. Okay, so on that basis only we are building our both the profit margin as well as now the market share will be built on those kind of basis. Please count on at least 3 or 4 interesting products on this financial year as well, and this will become substantial from the month of October and November. Even though the launches are happening, two of the 4 products already launch is happening right now, but the benefits will be realizing only by October and November, when the next season is the time where we will realize. So I think we have enough things going for us actually.
Okay, thanks a lot. Yeah.
Welcome.
Thank you. Our next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Yeah, good evening, everybody. Sir, coming to the only bright sign for this quarter result was the railway equipment segment. Could you throw some more light on what kind of order book positions we are in, and what are we seeing in the horizon now with Mr. Suresh Prabhu at the helm, and things apparently things are moving very fast there. So, sir, if you could throw some light on that and please elaborate on this one, sir, on the railway equipment side.
Actually, as we said in one of the previous questions, we really have done a lot of cost optimization, and parallelly we have a healthy order book, though as of now we talk about 45 crore, but it's a dated one. We have much more order book, and 2 of our largest products which have been going to the 18-month validation period is just now completed those period, and they are supposed to kick in as a major product for us. So we see a very good uptrend in both the order book and the overall revenue in the coming quarters. And overall, if you see, we are primarily a brake systems, a suspension and coupler systems player in the market, and we, with our global technology partners and the new products what we are launched, we are pretty deeply entrenched into this particular brake systems market, with only competing only with the 2 major multinational players like the Knorr, Bremse and Fabry. So we feel that with our low-cost manufacturing and the technology what we have developed both in-house and through our global technology partners, we should be able to really make a significant market share out of it.
So you told the order book position at 45 crore, if I'm not wrong.
Yeah, this is the order book position as of 1st of April. So like you said, after that the order book has increased, but as of 1st of April the opening position was 45 crores.
45 crores. Sir, that means one should not extrapolate that this was one-off quarter. I mean, we posted revenue of 55 crore and profit of around 10.5 crore. So this is not a one-off event. We can expect a better performance or a matching performance going forward also.
Going forward,
because it is very lumpy, sir. If you see the earnings in the equipment part, it depends on your order execution. It's very lumpy quarter on quarter, sir. There I was trying to get a sense of it, that what should be the ideal proposition going quarter on quarter or even for the yearly purpose, if you could explain that.
Yeah, but what I would like to say that it would be, though it's true that it is in a very lumpy, it shows pretty well because we had very good products, but the EBIT percentage and the income percentage, we would try to maintain a pretty good balance about what we would be going in the coming quarter. I would, just from giving a particular number out here, but we would be maintaining a very healthy percentage of EBIT versus the revenue.
So, coming to the tractor segment, what was the market in the southern India? You have been trying to penetrate in southern India for last year or so, wherein you don't have any prominent presence. What have been the market share there, sir?
See, I think overall what we call strong market and weak markets, and weak markets together represent something like a 4.5% market share for us. Okay, so within that weak markets, like Andhra is a case study, one of the case study where we wanted to become a little more thorough with our own capability. There, I think when we started some internal project, it was something like a 3%, 3 to 3.5% was our market share, preceding. So from there, we moved something like a 6.5% market share. So we moved a market share of 3%, of course at a cost. Okay, so we are becoming thorough, but the expansion to other region depends on the overall, how buoyant is the market, how comfortable is our bottom line. So it is the question of timing issue. So we do have an internal plan to turn around all this market over a period of next 3 to 5 years. So this is a little long journey. It's a 3 to 5 year journey.
But as of now, you will not be chasing the market share as you told earlier. You will be concentrating on delivering the EBIT numbers. And as of now, you are not interested to increase market share because the situation is not it's favorable. Even if you go for discount pricing also, it won't be easier to do so.
See, our first this is despite of the constraint and our first aim is to go towards that better EBITDA margin. So that is the direction number one. Subject to that, now we are getting ready for a better market share scenario as well. From a level of 10.5% market share, we are in the last 5-6 months, we are almost at 11% types. So maybe over a period of 2 years, we clearly see a possibility of a market share reaching up to 12.5%. So far, we never spoke that language because we were not ready. So now that those kind of evidences will start falling in place, then onwards we will see a very good momentum there in the market share as well.
Correct, sir. And I must thank the board of directors for maintaining the dividend payout, even though it was a very tough year. Great thanks to the board of directors, and thank you. That's all from us, sir.
Sure, we appreciate your coming.
Thank you. Next question is from the line of Basudev Banerjee from Antique Finance. Please go ahead.
Yeah, just missed out one question, sir. Nothing related to the results. As of late, one can see Escorts ad on TV per se, showing the overall product portfolio. So, being a tractor manufacturer, taking care of the TV media route. So, any other perspective into that? So, what's the intention of coming on TV media? Anything on that angle, sir?
Okay, see here, what we are attempting is. If I am to give a broad picture, I think this Escorts is a re-engineered Escorts. It's a resurgence of Escorts. So this is a true reflection of what is happening internally, not the externally. Now, even though the results always comes with a little lag effect, but we thought it's the time to tell people on what is truly happening internally. So the true image formation of Escorts. So two distinct products of construction equipment and the tractor. And the engineering as our language, what we are trying to bring in with the modern connect with the system and the countries is what we are trying to reflect. I think it's receiving the rave response. I think your question, I think, is also reflecting on the same thing as you.
Sure, sir. Thanks.
Thank you. And our next question is from the line of Sami Deshpande. Please go ahead.
Hello, good afternoon, everybody.
Good afternoon.
Definitely a challenging time for the tractor industry. When I was looking through our figures, I could see that 11,000 level of volume for a quarter was not witnessed by our company for at least last 6 to 7 years. So it has taken us back almost by 6 to 7 years. Because it was around 2006-07 when the company was extremely in a troubled shape. We were witnessing those volumes. So it is really, I think, a very bad time. But I think from hearing from the commentary, I feel the 1 to 2 quarters still the pain is going to continue. And when we are saying that we expect a flat year, if the year is flat for the industry, and if we also is it possible for us to maintain the volume around 60,000 in this scenario? In that case, the second half has to be really very good, despite the low base effect.
Yeah, the answer is resounding yes, but the yes is not coming out of what will happen in the market, but the yes is coming out of what we are internally gearing up, how we are organizing ourselves, the kind of a product, what we are trying to put it between now and October, November. I think we believe so.
Achha. And okay, then in that case, automatically the margins should go higher, and we can go to around 7-8% level for the year. Segment margins.
That's right.
Achha. And regarding this new campaign, I would like to compliment you all for the campaign. It is on the TV which we are looking. It is really a good thing, idea to project Escorts not only as a tractor company, though it constitutes 80% of our turnover and almost 100% of the profits. But you are projecting it to be an engineering company, presence across the various segments, and railways, which is expected to get a lot of fillip with the new minister in place, as well as this construction equipment. I think so. All the best to you all for that. And one more question on this construction equipment business and auto ancillary. See, despite our efforts this year also, we had to lose around 50 crores on those two businesses together. So now when we are expecting the second half to be better for construction equipment, so in that case, if the turnover is around 515 crores this year, we have lost over 25 crores. So at what level of turnover are we likely to come EBITDA positive? Because our capacity utilization is hardly 23%, if I have heard correctly. So for construction equipment and as well as auto ancillary, at what level of turnover we will be EBITDA positive, and when we are likely to achieve that?
Yeah, this is Saxena here. On the construction equipment, what I would like to just place before you is, there are almost 38 players in the country, out of which almost 26 are manufacturers. All of them are actually having a capacity utilization in the range of 20%. So we're not alone on that. And what you see as 20% is on a 2.5 shift basis. Everybody is operating almost for about 10 days of a month. And therefore, that's the situation industry-wide. In fact, the total industry volume from 74,000 in 11-12 has come down to as low as 41,000 this year. That's the kind of distress the industry is into. None of them making money, barring one, which is JCB. So almost everywhere, the situation is same. What is most important is the kind of growth that is needed to go back to 11-12 era, where the utilization was better, is going to take some doing. And therefore, what we expect is it's only in the second half that we see that there will be some amount of growth. It will still not mean that we go to 100% capacity utilization. It is still going to be in the range of 40 to 50% for the industry as well as for Escorts.
Mr. Deshpande, requesting you to return back to the queue for follow-up questions as we have other participants in queue.
Yes, sir. Just pardon me for this particular question. See, this this year we had a loss of 25 crores. So if we have a turnover of say 600, 700 crores, will we be EBITDA positive? That is my question.
Yeah, no, the question is right, but it has to be more related to the kind of volumes that we bring up. If we are at the volume of about 3,000 plus, we will certainly be EBITDA positive.
Because what was the volume this time?
It's just around 3,000. But what is more important is we have taken this time in the last 6 months to 8 months to really correct both the cost structure, the pricing, the contribution, the operating margins, everything. So there's a lot that is happening in terms of getting it right, and we have got it right. It's just that the market itself has come down dramatically.
Right.
So, and we expected it. In fact, the quarter 3 was the best quarter that we had after a very, very long time. But quarter 4 went down again for the industry, and we did better than the industry. So we rest assured, as a team and as Team Escorts, we are still doing better than the industry. It's just that the industry itself is seeing a decline. I mean, we talked about 6 months of continuous decline in the tractor industry. What you need to know is it has been 24 continuous quarters in construction industry which has seen a decline. It's not easy.
No, it is very difficult, definitely.
Yeah. So 26 quarters is far, far too long a recession period. No other industry, in fact, leave alone tractors, no other industry has seen this kind of a decline in India.
And auto segment, we have pruned our loss to 2.7 crores this time. So do we expect to turn around in next 6 months?
Yeah, we expect to turn around in next 6 months. We have taken a lot of exercises along with one of our BCG intervention. Q4, we should be seeing a positive EBITDA. And out here, what we are trying to do is that we have gone ahead and done a overall portfolio rationalization, and we have also breaking into some new geographies, particularly the European aftermarket. So we hope to complete the turnover by Q4 of FY16.
So you mean to have a zero loss at the end of March 16?
Yes.
Okay, all the best to you. Thank you.
I mean, it should be Q4 positive.
Q4 will be turnaround quarter.
Yeah. Okay, but this time we have about 2.7 crores loss. So if it goes on pruning in next 6 months, you may be zero. And then in second half, you may make some money. That is a possibility.
That's right.
Okay, all the best. Thank you.
Thank you. Next question is from the line of Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Hello.
Hello, sir.
Hello. So my question is both in this construction equipment and this auto ancillary, what is, I think there's been, what is the level of turnover by which, we will break even and make money?
So we should be able to break even at the same turnover of about 500 crores. Between 500 and 525, we should be able to break even.
In the construction equipment.
Right.
And what would be the EBITDA margin after that?
We should be in the range of about 4%. 4%
of the overall profit?
Yes.
I mean, at 600 crores, you should earn 25 crores.
Yeah.
And what about this auto ancillaries?
For auto ancillaries, it should be at least around 170 crores, and then the EBITDA would be something in the range of 3 to 4%.
In the auto ancillary?
Yeah.
Right. And what about this? The third one is railway equipment.
Yes.
What is the potentiality of turnover that we have? And what is the realization? What is the possibility that we get there?
Possibilities, potential turnover should be in the, we have a plan of at least 300 to 400 crores in the coming 1 or 2 years. And we are confident that we should be reaching that particular revenue numbers in the coming 2 years.
And if you do, say, 350 to 400 crores, should I have a margin of 10 to 12% or higher?
Yes, it should be higher, yeah.
But and so in this tractor business, what do you think are the factors which will lead to a turnaround?
Tractor industry turnaround?
Yeah.
I think, as I said, even though a lot of things are said about government policy, but I would expect it's more to do with the sentiment on monsoons. First for monsoon is on-time monsoon. Monsoon set on time is the most important factor, and then sustenance over a period of time is the second important factor. Third is the quantity of rains.
Right.
These three things are very important when it comes to monsoon.
And it's also not linked to the prices that they get for the produce?
Exactly. The second factor is the prices comes little more food. Inflation really enables. That puts people on fire. If these things are there, the recovery happens with the next season. Suppose if the first season is something like October, November, if one such a season we have faced, the second season, which is by March, April, May, we will see market on fire. So to that extent, it is more like a retail industry behavior. So recovery happens much faster.
No, sir, but what do you feel that over a period of, this year will be the second year of expected degrowth?
Yes.
Right? So, sir, when you have 2 years of degrowth, when you have the growth, you should have very good growth then.
Then normally what happens is, if I am to look back at the history as the basis of predicting future, then the coming back can be a stunning comeback. Means it cannot be a single-digit growth for the year 16-17. It can be something like a 15 to 25% kind of a comeback is what should be on cards.
And so, what is your estimate? What was the industry size last year?
550,000.
So this year you think if it remains at 550,000.
Yes. Next
year it will go to 650,000.
Yes. Yes.
Right. Well, I wonder, in this country, you have negative growth in a basic item like tractors. It's quite surprising actually. Anyway, we can't do anything about it. We are entering now new products and new segments.
Yes, yes.
That will give you confidence that you get market share.
That's right. Henceforth, it should be a market share story as well, in addition to the profit story.
And so, what is the kind of capacity we have? Can we manufacture 1 lakh or 1,20,000 tractors in current capacity?
At the current place, with the current machines, largely 1 lakh should be possible with managing the shifts and then little more tighter management. But the same place can also be stretched to the level of 1,20,000 with some investments. But that is still 1.5 years away from our internal discussion. But theoretically, it is possible to stretch up to 1,20,000.
And sir, because for initially you must have acted by giving a lot of discounts. Now the industry is, still competing very fiercely, or now everybody has decided it's better not to give discounts?
I think that sense will prevail maybe by end of this quarter, because this is not a one-odd, the fall is steeper. Right. I think industry will start stabilizing it, and that discount behavior will start stabilizing it. But we just don't participate, so really for us it really doesn't matter. We don't go into that place.
Right. Okay, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the floor back to the management for closing comments. Over to you, sir.
Thank you, ladies and gentlemen, for being present on this call. For any feedback and query, feel free to write in to us at investorrelation@escorts.co.in. I would like to mention that we distribute our earnings releases through our website www.escortsgroup.com. So do refer to our website for our earnings releases as well as other details, and this transcript will be available on our website after some time. Also, you can visit our social media pages for the latest company news, development, etc. We'll meet again in next quarter. Thank you very much and have a very good evening.
Thank you very much, sir. Ladies and gentlemen, on behalf of Escorts Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.